I want to get back to one of our top stories, and that is the Phase 1 trade deal between the U.S. and China. Specific industries likely to feel some relief from the agreement. But what about the broader U.S. economy? That's the question of the morning, and Steve Liesman is here with the answer of the morning.
Some answers, perhaps.
Some answers.
You know, Wall Street forecasters giving the trade deal mixed reviews over the weekend, applauding it for reducing tail risk, criticizing it for lacking detail, and yawning at it for perhaps being already priced in. J.P. Morgan writes, quote, global growth is still slowing, but the case for a rebound is building. It's the removal of the threat of further U.S. tariff hikes and an escalation of the conflict into other areas that damps risk. Question is whether this deal will lessen the uncertainty among business executives that at least partly is blamed for reducing capital spending and slowing growth. The Business Roundtable's CEO economic outlook continued to decline in the latest report. It's given up a lot of the gains from the Trump era. The trade detente could help begin to restore confidence, but that's probably going to take some time. Meanwhile, the economy has to digest the impact of the tariffs that remain. Oxford writes, the deal lacks in substance and features only a minor tariff rollback, leaving duties on 2/3 of our imports from China. The macro effects of the announced deal are negligible and won't prevent GDP growth from falling below potential in 2020. Wells Fargo arguing the deal was anticipated and the upside may be limited. I would add this, though. The market gets some trade improvement and the trade war insurance Fed rate cuts on top of all that, and those two may not have been anticipated by the market. The idea that you'd have the rate cuts, the lower Fed funds rate, and an easing of tail risk at the same time.